March 16th, 2013, Nicosia, Cyprus. A German retiree wakes up Saturday morning, checks the news. The Cypriot government announced a deal with the EU. Banks closed Monday. When they reopen, deposits will be taken, not loans, not investments, deposits. A portion from every account, confiscated, 150,000 euros, his retirement savings, everything he worked for. Saturday night, ATMs across the island empty within hours. Monday, Parliament rejects the deal. Markets crash. ECB ultimatum, find 5.8 billion euros by March 25th, or emergency funding stops. 1 week. Cyprus tries Russia, no. Tries bonds, no buyers. March 25th, larger bail-in, under 100,000 euros protected, over 100,000 euros, up to 47.5% confiscated. Bank of Cyprus takes 47.5% of deposits over 100,000 euros, converts to worthless shares. Cyprus. Popular Bank shuts down entirely, deposits over 100,000 euros, total loss. The German retirees, 150,000 euros becomes 76,000 euros, over 70,000 euros gone in a single weekend. But what happened in Cyprus in 2013 didn't stay in Cyprus. The European Union turned it into banking policy, not a bailout, a bail-in. Your money becomes their solution. Most people forgot Cyprus. But the mechanism never went away. It became policy. And in early 2026, with regional tensions rising and sanctions tightening, Cyprus faces the exact conditions that triggered the last crisis. Geography made Cyprus wealthy. Geography is about to make it poor again. The question isn't if Cyprus has a problem, it's how long until depositors realize they're the solution. But 2013 wasn't an isolated crisis. It was a test. And Europe learned from it. Cyprus sits at the edge of Europe, 80 kilometers from the Middle East. The island is divided, has been since 1974. North, Turkish-controlled, not EU. Different system. South, Republic of Cyprus. EU member since 2004. Euro currency. This is the part everyone means when they say Cyprus. European regulations, European legal system, European banking standards, but Middle Eastern geography, Middle Eastern proximity, Middle Eastern exposure. That positioning was the business model. For decades, Cyprus was the bridge nobody else could be. Russian oligarchs moving money, Cyprus banks. Lebanese businesses needing euro accounts, Cyprus. Iranian companies wanting European access before sanctions, Cyprus intermediaries. Then 2008, global crisis, Cyprus banks exposed to Greek debt. Greece defaults 2012, Cypriot banks lose billions. March 2013, Bank of Cyprus, Cyprus Popular Bank insolvent. Together, holding 68 billion euros in deposits, 4 times Cyprus GDP. Cyprus needed bailout, had no money. EU said yes with conditions. Take 5.8 billion euros from depositors. The precedent was set. If it happened in Cyprus, an EU member, it can happen anywhere in Europe. Deposits over 100,000 euros are not savings. In modern banking, they are emergency capital. Capital controls followed. Cypriots couldn't transfer money abroad for 2 years. Daily withdrawal limits, border cash restrictions. Economy contracted 13%. But the banks survived. And that's what mattered to Brussels. Geography is only the first problem. The second, what Cyprus built on top of it. A banking system designed for money that doesn't want to be seen. Cyprus has no oil, no industry, no natural resources. The entire economy runs on one thing, other people's money. 126 billion euros in deposits. In a country with a 20 billion euro economy, the math doesn't work unless deposits aren't from Cypriots. They aren't. 60% foreign, Russian, Lebanese, Ukrainian, Iranian, Syrian. Move money out of Russia without questions. Cyprus. Euro accounts for sanctioned businesses. Cyprus. Intermediaries. Regulated enough to be respectable. Flexible enough to be useful. The 2013 crisis didn't kill this. It exposed it. After the bail-in, deposits dropped, but they came back. By 2020, 45 billion euros in deposits again. Still 2 times GDP. Still majority foreign. The system survived. But the people who came back were even riskier than the ones who left. Before 2013, Russian oligarchs, Lebanese traders. After 2013, still Russian oligarchs. But now under sanctions. 2022, Russia invades Ukraine. EU sanctions. 2023, sanctions expand to anyone facilitating Russian capital flight. 2024, Middle Eastern sanctions tighten. Cyprus banks caught in the middle. But after 2020, a second wave arrived. Online entrepreneurs, YouTubers, crypto traders, digital nomads, drawn by Cyprus's 0% tax non-dom regime, the 60-day residency rule, a tax optimization paradise. Between 2020 and 2025, more than 50,000 remote workers moved to Cyprus. Most of them have no idea they moved their savings into the same banking system that confiscated deposits in 2013. They post Instagram photos from Limassol beaches, make YouTube videos about Cyprus tax benefits, run online businesses from Nicosia cafes. March 2nd, 2026. Drones strike British military base 40 kilometers from Limassol. They're still posting Instagram reels about tax optimization. They came for tax efficiency. They're staying in a conflict zone with bail-in exposure. Different money than Russian oligarchs. Same vulnerability. Both groups think they found a safe haven. Both wrong. Both are exposed to the same bail-in mechanism that confiscated nearly half of large deposits in 2013. And in early 2026, the same trap is closing again. Cyprus banks hold deposits from sanctioned entities. European regulators can freeze those accounts overnight. Not close. Freeze. Money stays on balance sheet, can't be moved. Trapped capital? Enough gets trapped, bank becomes illiquid. Can't meet withdrawals even though money exists. Early 2026, regional tensions rise. March 2nd, drones strike British Akrotiri base in Cyprus. No casualties. But the island, marketed as safe EU paradise, has active military targets in a regional conflict. Insurance premiums for Eastern Mediterranean exposure spike immediately. Tourism drops. Flights reroute. Business investments delayed. Geography isn't neutrality, it's exposure. Cyprus banks face two simultaneous problems. First, sanctions exposure. Regulators reviewing accounts, flagging Russian connections, freezing suspicious deposits. Estimates, 15 to 20% of foreign deposits now restricted. 7 to 9 billion euros trapped on balance sheets. Can't be withdrawn, can't be moved, just frozen. Second, flight risk. Foreign depositors see the pressure. Don't wait for their accounts to freeze, they withdraw. Quietly at first, then faster. Q4 2025. Foreign deposits decline for first time since 2014. Early 2026. Outflows accelerating. Not crisis yet, but pattern identical to 2013. Confidence eroding. Capital leaving. Pressure increasing. The bail-in mechanism from 2013 isn't gone. It's EU banking policy now. Bank Recovery and Resolution Directive, adopted 2014, active across all EU member states. Explicitly allows regulators to confiscate deposits over 100,000 euros to recapitalize failing banks. Deposits over 100,000 euros aren't protected anymore. They're designated creditors, and creditors get wiped out before taxpayers contribute a cent. Cyprus proved this works. EU made it permanent. The playbook is written. But here's what makes Cyprus different from every other EU country. Capital flight accelerates. Depositors pull money faster than banks can survive. Liquidity disappears. Regulators step in, declare banks failing, impose resolution, freeze deposits over 100,000 euros, convert portion to shares, confiscate rest, playbook identical to 2013. Only question, how much they take this time? That was extreme, but it worked. Banks survived. System stabilized, depositors lost money, economy didn't collapse. The EU learned something important. Depositors are the cheapest form of emergency capital. No parliamentary approval needed, no taxpayer funding, just declare emergency, activate resolution. Monday, accounts frozen. Friday, money gone, clean, efficient, legal. Cyprus most vulnerable, small economy, isolated geography, high foreign deposits, sanctions exposure, all 2013 conditions back. Cyprus, 1.2 million people, 45 billion euros in bank deposits. If 20% leaves quickly, 9 billion euros in withdrawals, banks can't handle it. They'd need ECB emergency liquidity. ECB would impose conditions, and conditions would include bail-ins. Unlike 2013, there's no surprise this time. Everyone knows the mechanism, they've seen it work. The trigger isn't the crisis itself, it's perception. The moment enough depositors believe it's time to leave, it becomes time to leave. And once that starts, it can't be stopped. The difference? In 2013, they didn't see it coming. This time, they're watching it happen in real time. Because banks don't fail slowly, they fail all at once. Runs happen because people think they might happen. And Cyprus, with 60% foreign deposits and structural flight risk, has the lowest threshold in Europe. One bad news cycle, one sanctioned entity publicly tied to a major bank, one regulatory announcement. That's all it takes. The German retiree from 2013 knows this. Over 70,000 euros disappeared because he didn't leave fast enough. He remembers the ATM lines, the panic, the helplessness. Waking up Monday morning to find his retirement savings had become bank shares worth nothing. Thousands like him are watching the indicators now. Regulatory pressure, deposit outflows, tourism dropping, the pattern from 2013 repeating. They know what comes next, because they've already lived through it once. Location created wealth. Between Europe and Middle East, between legality and flexibility, banking hub worth billions, but location made Cyprus fragile. Islands can't escape geography, can't defend without picking sides. When Europe decides Cyprus too exposed, too risky, too small, Europe lets it fail. 2013 proved that. And the rules say depositors pay first. The bail-in from 2013 became EU banking policy. Every European bank operates under same framework. And when a bank runs out of options, your account becomes the bailout. The German retiree checks his account regularly. Balance, 85,000 euros, just under threshold, kept deliberately low, because 100,000 euros is the line between protected and exposed. And if crisis comes, that line is everything. He knows what happens next. He's seen it before. March 16th, 2013. That day taught Europe one lesson. Depositors are the cheapest bailout. No parliamentary approval, no taxpayer funding. Just freeze accounts and take what's needed. Cyprus proved it works. EU made it policy. And now the same conditions are back. Sanctions exposure, capital flight, regulatory pressure. The German retiree is closing his account, transferring to Germany, moving physical cash, whatever it takes. So is the YouTuber who moved there in 2022 for tax optimization. The one who made videos about Cyprus tax benefits and digital nomad paradise. Different reasons for coming, same reason for leaving. They won't lose money twice.